When you're looking at a business from a valuation point of view, it's quite easy to sort of fall in love with the same business as everyone else has fallen in love with, and you pay too much. I think in very simple terms, happiness is expectations exceeded. And if expectations are very high, not much has to go wrong for people to get disappointed. And then that can have a very disproportionate effect on the valuation. So we're a bit careful about getting too excited on a valuation basis.
We like price to earnings ratio and dividend yield because that's what we get as a shareholder. There are lots of valuation metrics which often start much higher up the profit and loss account. But the problem with these is that there's a lot of cash leakage before you get all the way down to the earnings at the bottom. But obviously it is helpful for peer comparisons.
And we're quite happy to accept something which has got a few wrinkles and we have to sort of work through something and get a much sort of more attractive starting point. What we don't try and do is just to get super bargains which aren't good businesses. I think that's a mistake. There is a sort of happy middle ground and we try and occupy that.
We often look at trailing earnings yield to see what will happen if there's no growth. We like dividend because it shows a mature and disciplined business. We avoid concept stocks and we tend to get vertigo of about 23 times price earnings, unless there is a high dividend yield as well with low debt, because this offers downside protection.
I think we can all get very excited about a very obviously good business, but that tends to be more than reflected in the price. And I think what we're always trying to do is find a good business which hasn't either been really discovered yet, and that tends to be more in the sort of mid-cap area, or a good business which may have stumbled and the market's overly punished it.